5 credit myths that are costing you money. Are you accidentally following bad credit advice that's silently draining your wallet every month? You might be. Because in 2025, some of the most common credit tips you see on TikTok, Instagram, or even from friends are actually hurting your credit score and costing you real money on loans, credit cards, and even car insurance. Today, I'll bust 5 of the biggest credit myths people still believe and show you the right strategies to protect your score and your money. If you've ever heard that carrying a balance boosts your score, or that closing old accounts helps your credit, this video will change the way you think about credit forever. Agenda plus promise. By the end, you'll learn the 5 most expensive myths costing you money, the truth behind each one, and step-by-step fixes to instantly improve your credit profile in 2025. Myth 1. Carrying a balance builds credit. The myth. Many people think leaving a balance on your credit card helps your score. Some even believe you have to owe money to build credit. The truth. That's completely false. Your credit score doesn't care if you carry a balance. It only cares about usage and on-time payments. When you leave a balance, you're just giving banks free money and interest charges. Example, you have a $1,000 credit limit. You spend $500 and leave $400 unpaid. Even at 22% APR, that's $10 interest every month. Money wasted. The fix. Always pay your balance in full if possible. But if you can't, keep your utilization low. Ideally under 30% and under 10% if you want top-tier scores. Pro tip. Your statement balance, not your payment due balance, is what gets reported to the bureaus. Pay before your statement closes to report a lower balance. Myth number 2. Closing old accounts improves your score. The myth. Some believe closing old cards cleans up their credit profile and boosts scores. The truth. In reality, closing old accounts can hurt your score in 2 major ways. In credit utilization impact. Closing a card reduces your total available credit, which increases your utilization ratio. Higher utilization bikes lower score. Dual credit age impact. Older accounts increase your average age of credit, an important factor in your score. When you close them, you shorten your profile history. Example, you have 3 cards. Card A, $5,000 limit, 8 years old. Card B, $2,000 limit, 3 years old. Card C, $1,000 limit, 1 year old. Total limit, your $8,000. You close Card A. Total limit drops to $3,000, utilization spikes, and your average age shrinks. Result, your score can drop 20 to 40 points instantly. The fix. Keep old, no annual fee cards open even if you don't use them often. Set up a small, recurring charge like Netflix or Spotify. Then auto-pay it to keep the account active. Pro tip. If an old card has a high annual fee, call the issuer and ask for a product change to a no-fee version instead of closing it. Myth number 3. Checking your credit hurts your score. The myth. People avoid checking their credit because they think it lowers their score. The truth. There are 2 types of credit checks. Hard inquiries. When a lender checks your credit for a loan or card application. These can drop your score by 3 to 5 points temporarily. Soft inquiries. When you check your own credit via apps like Credit Karma, Experian, or your bank. These do not affect your score. Why it costs you money. If you don't check your credit, you could miss identity theft, incorrect negative marks, opportunities to improve your utilization. The fix. Check your score monthly using free tools. Use annualcreditreport.com for your free full report from all 3 bureaus every 12 months. If you find errors, dispute them immediately. Myth number 4. Applying for multiple credit cards is always bad. The myth. People assume applying for more than 1 card destroys your credit score. The truth. It depends on how and why you apply. Multiple hard pulls in a short period can hurt temporarily, but responsibly opening cards can increase your available credit, reduce utilization, and boost your score long-term. The fix. Don't open 5+ cards in a single month. Space applications 3 to 6 months apart. Before applying, check if the issuer offers a soft pull pre-qualification to avoid unnecessary hard inquiries. Pro tip. If you're planning a mortgage or auto loan in the next 6-12 months, Avoid new credit card applications until after the approval. Myth number 5. Paying off debt instantly fixes your score. The myth. People think paying off a loan or card automatically pushes their score into the excellent range overnight. The truth. While paying off debt is great for your finances, the impact on your score depends on the type of debt, how it reports, and your overall profile. Why? Paying off installment loans, like auto loans, can actually slightly reduce your score because you lose an active account in your credit mix. Paying off credit cards usually helps, but if you close the account after paying it off, your utilization can spike and lower your score. The fix. Celebrate paying off debt, but don't expect instant miracles. Keep accounts open and active if possible. Focus on keeping utilization low before applying for major financing. Wrap up an action plan. Credit success in 2025 isn't about hacks. It's about understanding the system and avoiding these costly myths. 1. Don't carry balances unnecessarily. 2. Keep old accounts open if possible. 3. Check your credit regularly. It won't hurt you. 4. To be strategic with new applications. Pay off debt smartly and manage utilization. If you want higher credit scores, lower interest rates, and more approvals in 2025, avoiding these myths is step 1. If you enjoy the video, don't forget to like, subscribe, and hit the bell icon on for more videos.